Good morning, sense of things. It is Jeff and Ron here for another week of fun facts, the markets, and what's going on in the economy. Ron, good morning, sir.
Good morning. Not a big news week. CPI came out today a little hotter, 3.3 versus 3.1. But you know what? The political hot stove is heating up. And to get your popcorn ready, keep off the social media, folks, or don't read all the text from the far left-wing people in your life. Live your life, rest,
Stick in the
relax,
center and life's good.
chill.
Yeah.
Yes. Yes, do your own research. Find your own facts that make sense. Don't interpret other people's BS.
Absolutely. And so
Please.
I thought this morning to kick this whole thing off, we're kicking off political season. Monday is the Iowa caucus and all that. And what I continually hear is how there's all this discourse and how it's way worse today than it ever was. So I thought what I would do is share a little bit of history, because I am a student of history. Oh, wait a minute. Hang on. We got to, yeah. So let me share here with my screen. Okay, here we go. So back in the early 1800s, about 1825.
Was that in the last presidential election? Oh,
I think so. Yeah, it was pretty close to the last presidential election, but this was actually in the 1820s. Senator Preston Brooks from the South went into the Senate chambers and beat the living tar out of Senator Charles Sumner because they disagreed on just a few things, and one was a slavery advocate and one wasn't. And
was it a social media post that he was upset about?
Yeah, I think so. It was probably a social media post. They posted it on their wall, which at that time you just literally took a push pin and put something on your wall. But yeah, definitely it could be worse. And of course, the funniest part about this is the one thing about politicians that is still true: he almost beat the guy to death. Sumner was unconscious for several days, didn't go to jail at all for it, didn't even get prosecuted for it. So I thought that was just absolutely hilarious.
Justified homicide, I think that's absolutely what it was, right? Okay.
Burr-Hamilton duel. So the sitting vice president of the United States murdered in a duel the former Secretary of the Treasury, the first Secretary of the Treasury. Once again, didn't get put in jail, really didn't end his political career very much at that point, but things could be worse.
Hold on, before you go to the next one.
Yeah.
I found this out by watching Pawn Stars years ago. Okay. At that time and before, there was a kit that was sold with what was called dueling pistols.
Yep.
And there were two pistols in there. So this way it was an equal caliber, equal weighted, equal type of a pistol. And that's how they solved disputes, was actually through dueling, and they actually had dueling pistols.
So they brought them, one of the people brought them, and it was exactly the same. Yeah. Beautiful kits of them too. A lot of them are beautiful weapons.
Oh, very ornate.
Presidential comments about others. Andrew Jackson said that he had two regrets: that he didn't shoot Henry Clay, who was a senator, and he hadn't hanged John C. Calhoun, who was his vice president for the first administration of the Jackson administration. He was a little testy of a guy. Theodore Roosevelt talked about William McKinley. McKinley had no more backbone than a chocolate eclair.
I used to love those when I was a kid.
Yeah.
I'm not kidding.
President Henry S. Truman on Dwight D. Eisenhower: the general doesn't know any more about politics than a pig knows about Sunday.
That sounds like a current day quote.
It is. It's very much. Then Dwight D. Eisenhower, so next president in line on Richard Nixon's contributions as his vice president: if you give me a week, I think I might think of one. I don't remember.
I've seen the video of that. That's very interesting, and I think that hurt him also.
Yeah, I think it did too.
Lyndon B. Eisenhower was very well respected, and that would have been a great endorsement. Anyway.
Yeah, exactly. Lyndon B. Johnson on Gerald Ford. This tells me Lyndon B. Johnson, growing up in Texas, Jerry Ford is so dumb he can't fart and chew gum at the same time.
Hey, listen, isn't that with most politicians?
Yeah, I think it's pretty much a given. But
or is it the other way around? Chew gum and okay. Yeah. Okay.
Yeah, he was just stating the obvious. Now, If you've ever been to the LBJ library here in Austin, there is actually a photo of him sitting in the bathroom on the toilet talking to his cabinet at the time. So he was a different animal. And I think the last quote, I couldn't fit it on this page, but I thought it was very funny. Sure. It was Jerry Ford then saying about pardoning Nixon that he knew he was going to be going to hell because he was pardoning Nixon. Although we have a lot of discourse today and we have a lot of fighting and infighting in the parties and everything else, it's not changed since the beginning of this country, and it hasn't changed probably since before that even.
Well, if you think about it, what was the mode of communication prior to 1900 for the most part? It was newspapers.
Yeah.
And the majority of the newspapers were corrupt.
Absolutely.
They were paid off. Politicians had a slant, depending on who owned them, Hearst and going,
yellow journalism and everything else. Yeah, basically they were the cable channels of their day. There was a ton of newspapers and they were all fighting to get subscribers to their newspapers and everything else. No different from all the different cable channels today and all that. So
I think it's interesting. I love documentaries, especially bio documentaries. And I believe there was one on Hearst that I forgot who he had discourse with, but all his rhetoric that he put in through the papers created, I think it was the Spanish-American War.
It's probably without a doubt.
I think it was either that or something else. I'm upset. I'm not 100% factual about that, but he did create a war. I think it was the Spanish-American War because of the lies that he went through and people just believed it. So the rhetoric, it grew and grew, and then politicians believed it.
I think it all related. Yeah, it all related to the USS Maine incident, that his newspapers were like, oh, it was blown up and all that. Now, what they found throughout history and reviewing the wreck and everything else, they realized it was just somebody probably smoking in a powder magazine or something like that caused the thing to blow up.
I hear you. All right, here
I got a whole war around the world about this.
I got a good fun fact, and then we got some interesting either economics or something we typically don't talk about very often. Let me know when you can see the screen.
Yep, it's up.
So I saw this. It's not a pretty visual of the one that I saw on TV, but the market cap combined of the stocks that everybody's aware of, Microsoft, Apple, Google, Amazon, Nvidia, Facebook, and Tesla, is greater than the stock markets of the following countries combined. 7 stocks are more than Japan, Canada, and Britain, and UK combined.
Yeah. Wow.
And actually, I'm not sure, but I believe Microsoft is about to surpass Apple today. They're neck and neck for 2.8 trillion or wherever the hell they are. Greater than 3 countries combined, which is another reason we brought it up last week in our podcast, that the top 10 stocks in the S&P were responsible for 75% of the index's move.
It's just logical because you've got now so many index funds and everything else that they have to, it's just a self-perpetuating thing that's going to be there. Yeah. Yes, they'll be volatile and they'll move up and down a lot, but the underlying part of it is until we have some kind of major pullback in the markets, they're going to just continue, or the market, the S&P again tries to rejigger it a little bit and
in a way they have to. Logically, they have to, but obviously the fund managers don't want them to because they got all the inflows, they got all the fees. It's almost like a cannibalizing situation.
Yeah.
All right, we have some other good stuff here. So just digging into the numbers, and I don't care what administration is in the White House, the actual number here that everybody sees, right? This is what's reported. You got to dig into those numbers. So again, these are estimates, but I'm not going to go through every single one of these, but I'll go from the bottom up. 683,000 fewer people employed, 676,000 people left the labor force. So think about it for a second. That's another 1.2, 1.3 million people that aren't getting a paycheck.
Yeah.
Every week or every 2 weeks or whatever it may be. We know about temporary jobs, right? I was surprised that they were let go in December. Usually seasonally, they're let go in January. So it should be interesting to see how this progresses over the next couple of months. because usually January is a big month for getting rid of seasonal workers. And when manufacturing and tech, they start to clean house. Actually, Amazon just announced they were laying off, I think it was several hundred or 1,000 jobs across several divisions. So I don't know whether that's the snowball effect or what, but we'll have to see.
I would, just from talking to tech recruiters and things like that, what they're seeing is that the tech companies are getting back to their normal cycle, which is they every year, what's normal in the tech industry is every year they get done with the end of the year and they look at the bottom, let's say 10% of performers in their companies, and they just let them go at that point. And so that's somewhat normal. And then you've got people, then they get laid off from one, they bounce to another tech company and all that. And if they really suck, they get let go another year later at that point.
And if they're a growing company, riding the coattails of what you said, they'll get rid of the bottom performers and they upgrade. They're bringing in people that have more potential, better experience, more capability. So that's why a lot of the tech companies, if they're doing well, they're either maintaining or growing, but they're replacing underperformers.
Interesting. And I'll have to get the actual facts on this, but I heard a commenter on the news the other day talking about the same thing, the jobs report. But what she was saying is the real glaring thing about the most recent jobs reports is that the amount of temporary jobs that are available has been the fastest declining thing. Temporary jobs are typically that foot in the door. Okay, I get in and I get hired on, and that's been the thing that's come off the scenes much, much faster.
But don't forget, a lot of those temporary jobs, part-time jobs, those are also second and third jobs for people who are side hustles.
That's exactly it. Yeah.
So, all right. Yeah. So the next thing is we follow the PMI. And for the folks that aren't familiar with PMI, this is tracking manufacturing in the US. 50.0 is the belt line. Above 50 means manufacturing is doing well and expanding. Below 50 means there's a contraction. And I think that this is interesting. Lynn Alden, I pulled this from her newsletter. It's an excellent newsletter. It's free. She does it every 6 weeks. She's like a data scientist. She really digs down a lot of numbers. You can go, I'm pitching her. You go to her website and sign up for a free newsletter. So she put this together, and you can see there's been contraction here for over a year on the PMI. Now, I know that there are sections, New York and Philly and different metro areas have this is aggregate for the US. And I think this is interesting because typically manufacturing is a sign either in the beginning stages or early stages of a major contraction in the economy and or a recession. So we'll have to see how this pans out here in the first half of 24.
Yeah.
Federal debt held by the public. This is disgusting. We've talked about this several times. This is just another chart showing our percentage of gross domestic product, GDP, of the debt. This is the projected for where we're at the end of 2023. The next two generations behind us, if they don't understand what's going on, they're going to be pissed when they become midlife crisis or whatever. Somebody's going to be paying. Remember, we talked about it a couple of months ago. Just that what we're paying on our debt has surpassed our military budget.
Yep.
That's how horrible and disgusting this is. And neither side on the political spectrum is doing a damn thing about it.
Yeah, it seems like, once again, it's always going to be, until something massive happens. And, what the massive happens is
credit crisis.
Yeah, credit crisis where the international countries around the world go, you know what, we're not going to deal with you anymore. It's very much like what happened to Japan. Japan went through that period of time where they were ruling the world or were controlling a lot of things, and people just stopped buying their debt.
Also, I think it was early 90s, right? I think that their debt levels were 200 to 300% of GDP. Look where our numbers are. We're creeping up there pretty darn quick. And I wouldn't doubt if we accelerate faster than this if it's not under control.
Yeah.
And obviously back here, this was wartime, right? Yeah. But we paid that off through business expansion and not printing money.
Yeah.
So we shall see what happens. All right. So I thought this was another thing from our Federal Reserve with St. Louis, the
Mm-hmm.
percentage of equities held by the wealthiest 10%.
Mm-hmm.
This is the last 35 years, folks. This is unbelievable. Obviously, you need money to make money, but you know what? That means that the wealthiest money is their money is in the stock market. They're in those top 7 to 10 stocks. They're adding to it and they ain't selling it. And they're just riding the wave. And
you got to think too, this is the period of time where interest rates have been exceptionally low. Right after 2008, interest rates went to zero. So the only game in town was stocks. So people were having to take more risk, put money into more stocks and less into bonds and things like that. It really makes sense while we're here, why we're here.
And we could see it, right? This was the dot-com bust. People got out of equities, and by the time they got back in, if you remember, the bull market started again in late 2001 and 2. So by the time the money came back in, it was late. Obviously, the financial crisis here, we troughed out March 9th of 2009, and this was actually late. So this was late to the table. Again, consistent contributions, and the wealthiest people just kept their money in and wrote it out. If you notice here, there wasn't much of a pullback in 2020, although it was short-lived, right? We had a 30% decline in 6 weeks. We bounced right back pretty quickly. And then just to wrap up here, I thought this was interesting. 2 reasons. One, you've heard it over the years about CEO, C-suite pay. And obviously on the left side here, we talk about stock awards. And this is also the propping up and the manipulation of stock because, oh, by the way, we'll issue you another 1 million shares of stock if you get it above 50. It's at 38 now. What are you going to do between here or there? Do a secondary, manipulate other numbers, push off debt, increase dividend, whatever it is.
Buy
they want to hit their bogeys.
Yeah, buy back shares is really, you figure most of what happened over the last, let's call it 7-8 years, you had virtually zero interest rates. So companies could go around, borrow at 0% interest rates or minimal interest rates, turn around, buy back their stock and prop the stock up at that point.
I think this is comical because it's I'm only making, sorry about this. I'm only making $100,000. Yeah, but you're getting $10 million in compensation, end of year bonuses, stock awards, RSUs, restricted stock units, warrants, whatever you want to call it. I'm only making $100,000. Oh, there are middle managers making $500,000. Okay, great.
I actually like the chart on the right though. That's the median CEO pay.
Yeah, and that's just crazy. And that just, look, I totally understand C-suites people. I'm very much into meritocracy. I know we've talked about this before, but that kind of pay is absurd. And I think it started 30 years ago, if you remember, with Eisner of Disney. When he cashed out, when he left, he had like almost $500 million. That was 30 years ago. And it was just like, people were like, well, he was only paid a couple of $1 million. He was right in line. Nobody really knew the back end of that. And of course, through growth and stock and everything else, his compensation overall went through the roof. Yeah, and he walked away with 400 or 500 million or whatever the hell it was. Anyway, okay, so that was me.
Excellent. I think you brought the point up. There was very little of anything this week when it came to economic data, but I think the only real thing economic data wise this week is we go to Econoday, not jobless claims, CPI. Yeah, jobless claims basically right on track with where it is. CPI, hello, come on, there we go. So CPI, the consensus was 0.2%, came in at 3%, out top of the range. So it was at least within the range, but we're still pushing on with ex food and energy year over year. We're still pushing at 3.9%. So when the administration and everybody talks about stuff is coming down, what you have to think about though is we're piling another 4% on top of the already 22% over the last 3 years. So it's not getting better, and the administration and Congress and everybody can talk about we're doing stuff to fix the problem, but it doesn't fix the problem for the people that are out there in the real world who are having to buy things and pay for
And I've
them.
heard market strategists talking about look for a spike in inflation in the beginning of the year. And
Yeah.
I don't know if that was because December, people were charging more for certain goods during the holidays, food, services, whatever it was. I'm not really sure. But I think it's interesting. Why I know in the 70s, inflation came down, spiked up again, but are we really going back to 45, 50 years ago to what happened then to compare to today's economy? I don't know if that's realistic.
Yeah. And it's interesting to see that typically the Fed will tell you, oh, well, we're trying to soft landing and everything else. I think what people have come to realize is they really don't have much control over things at this point, because you've got two things fighting against the other. You've got the Fed trying to slow things down, but then you have the federal government, and this is not one political party or the other one. They're both as bad as the other one. They're just pushing as hard as they can because we need to get reelected. So we can't cut money back from anybody. We have a system where Congress, every 2 years, the House of Representatives is reelected. So they're perpetually in this cycle of getting, trying to be reelected. So they're always trying to push things to make themselves be electable. The challenge is we keep pushing. It's like pushing on a string from the Fed's perspective of trying to slow this beast down. And it's just getting worse at that point. So I don't want to be Debbie Downer, but the reality is this stuff ain't slowing down, and things are not getting any cheaper for people.
No. So let's wrap up on this. So I'm going to ask you a question to get your opinion. How does all this, number one, affect the market? Because we can't time it. I was 3 to 6 months behind. I thought we'd get a major pullback or a recession end of 23, like a lot of other people did. Maybe I was 3 to 6 months behind. It'll happen the first half. But let's say it doesn't happen in the first half or the second half of 24, because it is a presidential election year. But at some point, the dam's got to break. So how does all this impacted us being portfolio managers and wealth managers and just pundits of what's going on in the U.S. and the world? How does this affect our economy and our markets? Because ultimately, our clients want to know.
Yeah. And I look at it, I manage more on a monthly basis now than I ever have. Before, you could count on it. We've adapted our trading style a little bit. And I do say trading style because we do, in our company, we trade the market a little bit. We've adapted our style to say, okay, this stuff can reverse very fast too. You think about September, October, really August, September, October, it reversed very fast, very quick.
11%.
Very pronounced. And then what happens in November, it flips around the other way and it goes the other direction. I've had to adapt my style a little bit to say, okay, well, if things are starting to pull back quickly, we need to act on it more quickly. I can't just let it go and say, we're just going to see what happens at the end of the year.
Yeah, and you want to put new money to work, but you do it at market highs. With everything that we know that's going on, do you just go into short-term try? I know every client's different. You manage it similar to us. But at the end of the day, people are like, why am I sitting in cash? Hey, look, can't be market timers. You know what? Buy on I think this is a buy. As long as nothing major breaks or cracks, this is a year of buy the dip, right? 5 or 8, 10% dip, whatever it may be. Keep adding more on the way down. I don't think you want to add more on the way up. We both agree we're probably going to end up higher at the end of the year. But between now and the presidential election, with all the volatility, possible government shutdown again, we're going to deal with that BS in another 8 weeks or whatever. No, you don't chase the market returns at this level. We got a double top formation, the technicals. That's one of the worst formations to put new money to work. And we might have a blow off top. I think we're looking at a 10 to 12% pullback before we go higher, pending no cracks. So I just think, how do we synthesize all this information to say, what does this mean for our clients? What do we do today?
And you and I spend most of our lives putting these shows together. So I think we are a little bit more aware than most of the street advisors that are out there. And I just look at it as we've got to be nimble when we have to be nimble. And we've got to be willing to say, okay, I might give up a little bit on the upside to protect the downside, because the downside is the one that hurts the most.
Absolutely.
And so I've adapted my portfolios to where we've shifted a little bit more money out of the bond market. We've got some bonds, but we've shifted more money out of the bond market, and we have a little bit more exposure on the credit side of things, senior credit, because if rates go down, which they're likely to, at least that is something that's a higher yielding credit rate. It's higher yielding. It doesn't really matter about credit ratings. It's all about the individual companies that have that debt. That's really one of the shifts we've made to say, okay, I don't want to sit here in bonds making 4 to 5% for the rest of our lives. I want to do something that's doing a little bit better.
Right.
And it's something I feel is going to do better if rates start to go down over
100%. Yeah. We actually have another choice other than equities to invest in right now. I like preferred stocks, which acts like a bond. You could double dip, right? You get a nice 5.5+% dividend yield, which is only maxed at 20% taxes, and you're going to make money on the capital appreciation side. So now it's not just an income play. It's also a capital appreciation play. So we have more options today.
If you don't have interest rates pressing against you where they're going up and rates are going up and preferred rates are stable, and those stocks were going down for a while just for the simple fact of, okay, rates are going up, so I can buy bonds at 7 and 8% versus the 5% dividends. Now with that stable and potentially going down, those become extremely attractive, and especially the convertible ones. Because you get a double whammy on them.
Yep. We shall see. Well, I got some more economic numbers over the next week, and earnings starts. So we should have some additional fodder for next episode.
Tomorrow, all the big banks go through tomorrow. So that's going to be interesting. We've got PPI coming out. I don't really expect much of a change. I think it's probably going to be about where the expectations were, just like we saw with CPI. It's basically on the top end of the range. I would expect the same thing on the PPI side. So nothing, I don't think, shocking about that. I think earnings season's always crazy, and this typically is the good earnings season, because this is the one where you're getting the fourth quarter numbers. But it's going to be interesting because it can be all over the fence.
Gotcha. Yep. No, I hear you. Until next episode, we'll figure it all out between now and then.
Yeah, we'll figure out how to fix the world between now and next.
We only need a week.
Yeah. All right, guys. Thanks for joining us on the show. We thank you for being here every week and listening to us babble on about this stuff. And hopefully you enjoy the things we bring that are a little funny. And make sure, wherever you're watching this or listening, make sure that you hit that subscribe button, hit that upvote, and please make sure you turn that little thing on that lets you know, the reminder that lets you know these shows are out there. We do one per week for you. So thanks a lot, and we'll see you guys back here the very next time.